This is InvestTalk. Independent thinking, shared success.
Hi there. I own a small position in ENVX, ticker ENVX. They just declared a dividend in a form of a warrant. And I've never owned a stock that has done this before. They're going to issue a warrant for every 7 shares owned with an exercise price of $8.75. And it looks like it's going to expire in October of 26. My cost per share of my holding is actually $8.90, so it's just a little bit above that. What is this? I assume that they want to raise some money, and it's kind of like an option maybe, except the company is issuing it. Won't this dilute the shares? Like, what effect do you foresee this having on the stock? Thanks for all you do, and I will listen on the podcast.
Okie doke. So with this company, first and foremost, let's go over what the company is and what it does, just to give you a little bit of context here. Ticker ENVX is ENVX. They are a battery company, right? They design and manufacture advanced lithium-ion batteries for electric vehicles, for wearables, and their goal, like most battery companies, is to essentially improve battery storage and improve energy density. Now, over the past 3 months, they're up 135%, and in spite of that, they're still down 20% over the past 52 weeks. One of the reasons being, well, revenue's been missing. Growth has been not too great. Production capacity has been disappointing as well. And so, they did show a little bit of revenue in the last quarterly report that was to their benefit, a little bit of growth, but still missing a lot of expectations here. From an ownership perspective, this is a pre-profit company, right? You see net margins are very, very negative. Return on equity, negative 45.3%. They have a little bit of debt, though not too much debt, on a $2.8 billion market cap company, about $195 million in debt. Regardless, in terms of ownership, this is a company that I probably wouldn't own right now just because of the trends within the EV market, the difficulty of being within the battery space, how expensive it can be. And obviously this company is having some issues. But your question about warrants, right? The warrant upon exercise gives you the right to buy shares directly from the company. Okay. And so it is a derivative instrument that allows a company to raise additional capital. And for a company that doesn't have much debt and also has no profits, right? This is a way for them to finance their business. Now, to entice you, they will do it at a discount, which is the case here. And so if your cost basis is way above and you like the company, this is a good way to lower your average cost per share ownership. But you are correct, it does dilute existing shareholders. And so keep that in mind, right? But the core of it here is, should you be owning this pre-profit company? You are pretty high above where your cost basis is. I think you said it was around the $8 range. And given some of the struggles, I would probably not throw additional money in the pot here. That is ENVX ENVX Corporation. Let's go to Art from San Jose, who has a question about IQV. Do you own it, or are you looking to buy it?
I'm looking to buy it. It's in the healthcare, and I'm thinking about putting in increasing my portfolio 2 to 4% in that area. What would you recommend? Okay, well, let's take a look at IQV, which is IQVIA Holdings Inc. It is a clinical research services and healthcare data analytics firm. So they have 3 core segments here, right? Their technology and analytics, their R&D solutions, and their contract sales. Now, over the past year, this name is down about 25.81%, underperforming the sector by about 6.7% last year, and currently underperforming their industry by about 23.7% year to date, where they are underwater about 17, right? So the rest of their industry is positive here, down an additional 1.65% today. Now, the reason why, well, they've had some pretty solid bookings, and their backlog growth has been strong as well, but they've had some worsening and slow demand within their R&D solutions group, which
makes up the bulk of their business, right? Growth has been okay within technology and analytics here, but research and development has been really slowing here as some people start to pare down spending on CapEx that these companies and these types of companies would otherwise service. And so you see with growth here, right, you go from 11 billion to 15 billion from 2019 to 2024. That slowed pretty significantly. Not much growth last year and not much growth going into this upcoming year. Margins, though, looking pretty solid, about as high as they have been over the past 5 years. But because of this slowing growth and because of the underperformance here, it's now trading closer to where the low is over the past 5 years. Now, recently, Q1 2025, they did top estimates on adjusted EPS, on adjusted EBITDA, and revenue as well. But again, it's a real key growth story here that is a worry. Clinical trial market conditions are not great. And so this company having 55% of its revenue deriving from that specific area of its business, well, that is leading it to have some issues as well. Let's look at its debt picture on top of that, right? $29 billion market cap company. Long-term debt about $13.2 billion, net operating cash flow, pretty stable, free cash flow, pretty stable as well over the past couple of years. I think just given where the clinical trial market is, if you're looking for a healthcare company specifically, one who has already been struggling over the past 6 months and is likely to continue to struggle moving forward, may not be where you want to allocate your healthcare exposure to. At the same time, relative strength, momentum here, it's pretty weak, and the market isn't really signaling from a momentum perspective that there is a turning point from a chart. So I would probably keep this out of my portfolio for now, just given some of the struggles broadly within the sector and with the company specifically. There's IQV Holdings, or IQVIA Holdings, ticker IQV.
Hello, this is Dan from Walnut Creek, and I was curious to know why copper in general and Southern Copper Corporation, SCCO, have been taking it on the chin the last couple of days. Look forward to hearing your answer on the air. Thank you.
Alrighty, Southern Copper, ticker SCCO, is one of the world's largest integrated copper producers. And that's not the only thing they produce, right? They operate in Peru and Mexico. They produce silver, zinc, and other byproducts. But essentially, their big business is copper, hence the name. So geographically speaking, most of their revenue actually is derived external to the United States, right? They have their United States segment, they have their Mexican segment, Switzerland, et cetera, et cetera. Now, over the past 52 weeks, it's down about 8.73%, but in the past 3 months, it's up 21.25%. The volatility of this name is going to more so than anything tie towards the volatility of the industry. Now, in 2025, again, they've had a notable 15.9% gain, 13.43% gain after the past couple of days. And a lot of it has been driven by strong copper price trends and increased mining output, which is very company specific. We think, as we do own this name, and think copper exposure is important, right? Historically speaking, Dr. Copper was a harbinger for economic output, but copper is also a critical metal in the green energy sector. And so demand globally over the next 10 years is likely to be boosted regardless of internal US economic policy. And so for us, being exposed to copper as a long-term play certainly is something that would be wise. Right now, it's trading at about its average of forward-looking price to earnings, about 2.1 times forward-looking price to earnings. And so we continue to hold this name, right? We're getting earnings again on the 23rd of July for the next quarter. I just think it's important to know that, there are companies you invest in, there are themes you invest in on different time frames, and understand that for certain ones, like ones that are tied to the performance of a commodity, you need to be able to stomach that volatility over the short term for that investment. And so for us, we will continue to hold Southern Copper. We think it's a great name if you want to be exposed to the copper industry. That is Southern Copper Corporation, ticker SCCO. Alrighty, let's make it 2 in a row from 888-99 chart.
My question is today, I'm interested in purchasing an ETF, buying into it. The symbol is V as in Victor, G as in good, T as in Tom. It is a Vanguard Informational Technology ETF. Is this a good time to get in? It is or it isn't, but maybe you can give us a little guidance on that. Thank you very much, and I'll be listening for it on the podcast.
Ticker VGT is the Vanguard Information Technology ETF. It is a Vanguard fund, and Vanguard is known for two things, being passive and being cheap. And this is both of those. It is a passive, diversely exposed fund for the information technology stocks in the US, but it still has a lot of concentration. Why? Because there are some pretty darn large technology stocks. And so 15.7% of it is going to be NVIDIA. 15.11% of it is going to be Microsoft. 14.18% of it is going to be Apple. And so in spite of holding 321 names, so name diversity, the top 10 make up about 60% of the portfolio, and the top 3 make up about 45%. So understand the concentration here. It's concentration you're going to get not because of any active bet, but because this is just a passively invested, market cap weighted portfolio. Now, my guess is it rebalances quarterly or annually. Let's see. Difficult to say, but it is the other thing that I mentioned, which is cheap, about 9 basis points. And so, if you were trying to get this broad exposure to the tech sector or any sector in general, and you're not trying to make active bets, you just want to ride the market cap weighted theme in a cost-effective way, well, VGT or Vanguard's sector funds in general are a pretty solid way to do it. Don't think this is going to make some crazy active moves. It is a passively managed fund. If that's what you're looking for, VGT is a good way to go. That is the Vanguard Information Technology ETF. Alrighty, looks like we have a live call, another live call. James from New York, who you're asking about CCJ. Do you own it or are you looking to buy it?
I'm looking to buy it on a pullback.
Okay.
I just want to know what a sensible point to enter might be at this point.
That's a great question. We have held CCJ for quite a long time in a couple of our strategies, and it's done pretty well, right? Year to date up 41.47%. 3 month up 78%, past 52 weeks up 35.33%. And with the exception of 2024, it's outperformed the S&P 500 by upwards of 30% most years, right? Big outperformance in 2023, up 65% higher, right? Up 90% for the full year. This year, outperforming by 35% as well. And the reason being is just massive, massive demand, right? They had that 35+% rally year to date, 41% now, really has been driven by the rising demand for uranium amidst a lot of geopolitical tensions, suspension of certain stockpiles within Kazakhstan, and just growing nuclear energy commitments globally. It is such a powerful technology for energy generation that most countries want it as part of their energy load. And so as we see over the next decade, energy demand going to exponentially increase, not from people, but from businesses, right? The energy intensive cost of running all of these models, CCJ stands to do pretty well. And, because of that, it's trading at 53.3 times forward-looking earnings, which looks really, really expensive, but it's only trading about 6.8 times price to book value, only 13 times sales, which is at the upper end of its 5-year range. I mean, it's an expensive name. I certainly get that. And, I think one potential catalyst here, again, is the power of deregulation, right? There's a lot of regulation around the nuclear industry. There's a lot of regulation around business in general in the United States. And so the question is, does this administration try and fully unleash nuclear energy and continue to deregulate? And that could add to another leg higher here. And so the question is, what is a reasonable price to get into? We have trimmed it a little bit, but we haven't really reduced it beyond the weight that we want to hold it in the portfolio because we think those upward catalysts, albeit it can be a volatile name, are a good reason to hold it even at these prices. And so for me, I would probably, you see today it's up 2.65% when the rest of the market is red. I might even want to consider just slowly DCAing into this name because like any other energy name, these catalysts can be so rapid, they can be so quick, but also the long-term thesis holds, right? The demand is going to be there 2, 3, 5, 10 years outward. Great company. We hold it for our clients. That is Cameco Corporation, ticker CCJ. Alrighty, let's talk about something that we never talk about. That is tariffs. And that's because new tariffs were announced by the president, a 35% tariff on Canada and a 50% tariff on Brazil. And we all know those things, but what we are now seeing from comments from Austin Goolsbee, the Chicago Fed president, is, well, this may add a little bit more murkiness to the tariff, or rather to the interest rate picture. And that's because tariff-related price spikes could reignite inflation fears. Canada is a big trading partner for the United States. Now, despite inflation data year to date showing cooling, right, 2.3% year over year through May, well, that could frankly turn the other way and could turn the other way in an unsustainable way. The Fed has thus far been on a path to cut rates, been hesitant, hoping to get through the summer to see the impact of trade policy. But what happens if we keep kicking the can down the road? The impact comes later and later, and does the Fed continue to pause? It's the uncertainty that stems from whether or not these tariffs are going to be one-time price hikes or prolonged inflationary events sparking retaliation that has been influencing the Fed's response. And as we all know, that is counter to the desires of the president. Trump has been very vocal, had a lot of criticism about Powell. He's added a lot of political pressure. There was news I was seeing in the Wall Street Journal today that the White House may be looking at using a renovation at the Fed, claiming that Jerome Powell was either lying or mismanaged it to drum up cause for him to be fired. Now, the problem is, right, it's not just Jerome Powell that's keeping rates steady. It's an entire governing board that votes to keep rates steady. And now the chair does have a lot of power over them, but it takes more than just one person's vote to make moves. And so with that unknown inflationary impulse potentially on the horizon, and with the market doing well, and with the fiscal stress that has just been introduced with the big beautiful bill, the amount of spending, and with unemployment low, the economy's stable. It doesn't really seem vulnerable to new shocks such that we need to cut immediately. That's for now. It'll be interesting to see how the picture changes in May. Jerome Powell's term is up in May 2026, and I don't imagine the president is going to renominate him, given the nicknames that he has for him and his general disagreement with his policies. And so the question is, what happens next year if you get a Bessent or a Waller or a Hassett in there? What does that mean for rates? What does that mean for the stability of the financial system, for the inflationary effects? As always, though, right, the other governors kind of have his back. Goolsbee, president of Chicago Fed, emphasized the importance of Fed independence, warning against letting political influence affect monetary decisions. Righty, let's keep things moving and see if we can squeeze in one more answer before the break.
I had a question about Boise Cascade Company. Wood Products and Building Materials Distribution Company was kind of liking what I saw in regards to some of the things that they're doing, and was wondering what you thought about the company. Really appreciate your answer, and I'll be looking forward to the answer on the podcast. Thanks.
Boise Cascade Company is a manufacturer and distributor of engineered wood products. Its ticker is BCC. As the name suggests, headquartered in Boise, Idaho, has about 7,500 employees, and year to date has been really struggling, down 23.3%. underperforming its industry by 13.8%. So from a momentum perspective, not doing too hot. It's about a $3.5 billion market cap company. It's got $516 million in debt, and free cash flow has been falling, as has net operating cash flow for about the past 6 years. In that same time, margins collapsing a little bit from a high of 2022 when there's a lot of demand for finished wood products of 10.2% down to 3.6% this year. And so, what generally is going on with this company, right, is that construction demand and housing starts haven't really picked up that much. You see this huge revenue growth coming out of the pandemic. From 2019 to 2022, revenue nearly doubled. Since then, it dropped off, and it certainly has not recovered. And so while margins are compressing, in spite of debt staying the same, revenue is falling. And the golden rule of business is you don't want those numbers to go down. And with the market seeing, okay, tariffs on imported wood, tariffs on input costs, lower construction demand because there's fewer people that want to get out of their homes. Remember that even though interest rates or mortgage rates are closer to 7% now, most people are still locked into their pre-pandemic mortgages. And so why would you leave your golden handcuffs and buy a new home when it becomes so much more expensive? That's why this name has moved closer to its average forward-looking price earnings, about 10.2%. It's down about 2.25% today, maybe because of the announced tariff on Canada. Let's look at if you have any other suppliers or Canadian. It doesn't quite look like it. But either way, right, being a building materials sector name, when wood products, plywood, lumber can become more expensive because of imported lumber, when demand is lower because people can't afford houses, really makes it difficult in this environment for this company to succeed. And so I think within, this specific sector, it's a little bit risky for me given the overall macro picture. That is Boise Cascade, ticker BCC. Thanks for the call. We haven't yet gotten to one, so let's tackle a question from the InvestTalk YouTube channel question bank. This one from Tango Panzer on ticker ENVA. It says, I came across ENVA stock recently and thought it looked very enticing. Do you think it's a good buy? ENVA is Innova Corporation. It's a fintech firm leveraging its Colossus machine learning platform to offer online financial services, installment loans, lines of credit, small business financing, and money transfers to non-prime consumers. In Brazil, they also operate under the brands CashNet USA, NetCredit, OnDeck, Simplic, and Pangea. 98% of its revenue comes from the United States, 2% comes from Brazil. Growth, pretty solid, 17.7% on an annualized basis over the past 6 years. Margins for fintech name, pretty low in the past couple years, right? They had 34% net margin in the pandemic. That's fallen to about 8.9% now. So it looks like a lot of it is coming from their interest and taxes, right? Because you see that their EBITDA and EBIT pretty consistent over the past 3-4 years. Big drop off this year. And so as expected, well, they took on a bit more debt in the past couple years, from $1.4 billion in 2021, now at $3.5 billion now. It is a $3.2 billion market cap company, meaning that the debt on this company exceeds their market cap. At the same time, they're buying back shares, which is certainly good. In spite of their profitability falling, their cash flow looks to be improved as well. From a momentum perspective, they were ranging for a while in the 90 to 100 before they broke out a little bit ago. And one of the reasons why is accelerating loan origination and revenue growth, right? They had huge demand for consumer and small business lending, but I get a little scared anytime I read the words non-prime. And so when you have non-prime and underserved businesses, you have the potential for credit stress. And so all those companies performing well, up 75% over the past 52 weeks, in economic downtimes, it can be pretty risky. And it's trading about at its high over the past 5-6 years. So strong run up, very strong run up. If you want to invest in a name like this that has heavy debt that the market is saying is worth too much because there's about 10% short interest, understand the huge risks should things turn. That is Innova International, ticker ENVA. Last thing I want to talk about today is risks of ETFs, right? ETFs are increasingly narrowing. The typical fund holds 123 stocks in 2025, when in 1998, the average ETF held 503 stocks. And that's because newer ETFs are focusing on these niche themes, or even being single stock ETFs. There are so many ETFs out there that are single stock leveraged ETFs that try to amplify the daily returns or losses of one stock. And so people who treat investing more like gambling have been flocking to these things. But the problem is the average stock suffers an 81% max drawdown historically, and most never recover. And so narrow ETFs do not protect against this risk. Fund issuers, though, they love these narrow ETFs. They love these leverage ETFs. It is so little work, and they can charge such higher fees. And when retail investors are chasing this excitement, and there's a market for it, they're just going to continue to do that. Thematic ETFs like solar, cannabis, they often lose 70 to 90% in downturns, yet people are still there. And so if this describes you, if you want to be highly concentrated, if you want to be highly levered, understand the risks. Understand that you should probably not allocate more than 5% of your portfolio to it. Understand that owning a quirky ETF doesn't make you diversified. It makes you the exact opposite, exposing you to risks you weren't expecting. I'm Luke Guerrero. This completes another InvestTalk program. Justin and I thank you for listening or watching and encourage you to tell your friends and family members about our free podcast downloads or our free videos on YouTube. If you love this show, tell somebody about it. Tell somebody you like, somebody you respect, somebody you want to help about this program. Help us build the InvestTalk family. And if anything you heard today has made you think about your financial picture, your health, your financial health, your insurance, your taxes, your investments, what it all is, what is going on, we can help figure it out with you. Just head over to investtalk.com and hit the portfolio review button. It is a free and confidential service. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.